Hey folks, Daniela Cambone here for ITM Trading with a PSA for you today. If you see any slight pullback in gold prices or silver prices, this might be your cue to seize the moment and start your allocation of wealth into physical gold and physical silver. It's super easy to do by booking a Calendly appointment with us here at ITM Trading. The link is below in the video description. You pick the day, you pick the time that suits you best. And it basically is an education and strategy session centered around starting your journey by owning physical gold and physical silver. Do it today. You won't regret it. Are gold prices due for a significant correction? Joining me to talk this and so much more is Peter Boockvar. He is the Chief Investment Officer for Bleakley Advisors and of course, a frequent contributor to CNBC. Peter, so good to be back with you. Welcome back.
Thank you, Daniela. Great to be here.
Yeah, I'm taking a cue from the latest note from TD Securities here, saying that gold prices have yet to adjust to the market's shallower rate cut expectations and may be due for a significant correction. I mean, as we're speaking right now, gold prices down around 24 bucks, Peter. I mean, is it time for the metal to be taking a breather?
Yes, I think it maybe is due for a short-term breather, but just a breather. And that TD report citing what the Fed is going to do, well, gold didn't really care what the Fed did in 2022 and 2023 when it went up. So to say that, okay, the gold rally's over because the Fed may not cut as many times as it did before, we have to understand why gold is where it is. And I think a large part of that buying has been from central banks and less so the Western buyer who was buying other things because of higher interest rates.
Really good point, Peter. And I wanted to bring up the central bank buying because we've now seen China that was on a buying spree, pause now for the fifth consecutive month. I mean, are you buying the reporting? Because we never really know. It's so opaque what the truth is there. But why do let's say the pause is real. Why do you think they are taking this breather?
Well, on one hand, I know they want to own a lot more gold. And on the other hand, maybe they are a bit price sensitive to see how the price shakes out. But that's not going to stop them over time to continue to own gold. They're doing it not as a trade, so to speak, and trying to buy low and sell high. They're doing it because they want a strong currency and they feel like owning, when I say strong, meaning more stable rather than weak. And they know owning gold is an important thing to park your reserves in rather than U.S. assets and U.S. dollars. And it is a great other thing to own as part of your overall reserve complexion.
Peter, when you said just a breather on gold, what are you looking at that is keeping you bullish the yellow metal here?
So when I look at in addition to what I just mentioned with central banks buying broadly speaking, and I don't think that that is going to end anytime soon. I think the diversification of one's reserves outside of the dollar. When I say outside, there's still going to be a big dollar
Yeah.
allocation to it, but all you need is a few percentage points less, and it's going to flow into other things. And every barrel of oil that's transacted in yuan with Saudi Arabia or Russia, or every bushel of corn with Brazil, that's one new fiat currency that's created that's going to flow back into gold. You also have the Western buyer that is just only beginning to buy gold. And I think also in the whole debate of when do exploding debts and deficits, yes, in the US, but certainly globally, but let's talk about the US, when does it matter? And, for a while, I think everyone looked at the US Treasury market as being the first area where it would be reflected in the sense that market interest rates would go up irrespective of what the Fed would do because investors would ask for more money from the US government if they were going to lend to them. And then I started to think that, that's everyone's been looking for that for 40 years. In the mid 80s, people were complaining about US debts and deficits. But now I'm wondering whether those worries are now being reflected in the currency markets and in the price of gold. And that maybe,
Mhm.
just maybe, the price of gold to 26, 2,700, not just because of that central bank buying, but in part it is because central banks are buying because they want to diversify, but also because they do see the way that the US government is spending all its money, and they don't want to be the last man standing at the party owning all these US dollars, which, they don't want to be throwing those as confetti
Exactly.
to any end bash. So it is sort of interlinked that those worries are being reflected in the price of gold. And now, if you think that the US government is all of a sudden going to get religion and get a handle on the growth index and deficits, well, then maybe you should sell your gold. If you don't think that's going to be the case, regardless of who the next president is going to be, then you still want to own gold with the possibility of it going higher and silver even having more of a percentage
Yes.
potential gain relative to gold. I mean, we talk about this big move in gold, which is now about what, $700 above its prior peak in 2011, whereas silver is still almost half of where it was in 2011. So to me, there's more to this bull market, but I do accept, and as an investor and someone who's long it for myself and clients, I am sort of buckling up for the possibility of a correction and a pullback, which is normal in a bull market. And while it's difficult to live through, and you always say, "Oh, I should have sold some," uh, I still think that this sort of shakes out some weak hands, sets the stage for another move higher. I mean, any sprinter will run out of gas. A healthier run is a marathon where there could be some, slowdown in pace along the way, and even a breather is always a good thing to sort of recharge the batteries.
Peter, I just want to pick up on something you said there regarding the Western buyer and how they haven't showed up yet. I mean, obviously we see the appetite coming out of Asia for gold, and apart from Costco gold bars flying off the shelves, the Western investor isn't quite there yet for gold. Why do you think that is?
Well, I think because there's some competition. NVIDIA is competition for those investment dollars, Microsoft and Apple in the home Mag 7, and the stock market generally, in addition to rates where they are. Overseas, in Asia, in Brazil, in other parts of the world, in India, of course, and China, there's a culture to own gold. There's a culture to know that gold is a very important part of one's portfolio. But here you are, 24 years into this gold bull market that has exceeded the performance in the S&P 500, and the U.S. Western investor, still has this cult of personality and wanting to own U.S. stocks.
Right.
And to me, it's not until maybe there's another bear market in U.S. stocks that Western investors feel like maybe I should be owning gold. Now, there is a beginning of a change here. I mean, price sentiment follows price. It's never the other way around. So when people see that gold's where it starts to gain a lot of attention, particularly in the West, and it certainly is now. But I still think that there's this level of, well, there are other things that I can still buy. I mean, in 2022, 23, as I mentioned, the Western buyer said, well, hey, I can get a positive nominal real interest rate now on my savings. Why should I own something that doesn't yield me anything? Not understanding why gold was rallying in the face of that and still not coming around to that appreciation. So that's why, getting back to that TD report, yeah, it could be an excuse to have a correction in gold, but it certainly hasn't been, rates haven't been an impediment to gold. But, other stocks certainly are, as I said.
Peter, I want to take a step back now because you've been quite vocal about the confusion that's out in the market, and I think echoing the thoughts of many, including myself. Your tweet as of this morning, you said unclear as to what is going on out there. I was saying, yeah, I am, Peter. So is small business, as the NFIB uncertainty index rose to the highest record since 1975. By the way, that index provides an indication of the health of the small business sector. So talk to us a little bit about what we're seeing in the economy, because people don't know, is it good, is it bad? I mean, the jobs report from last week threw us a curveball there.
So when people look at the economy, there's a lot of like sort of broad brush type interpretations. I mean, just before this interview, I saw the Atlanta Fed raised their third quarter GDP number from 2.5 to 3.2. And seeing that, you think that everything is robust. And I like to sort of distill what is strong and what is not, because it's not all in the aggregate. There's nothing strong about manufacturing in the US or globally for that matter. Europe's manufacturing sector is in a recession. China is benefiting from the exports and productions of EV and solar panels and others, but other type of industrial things, they're suffering as well. So there's a recession actually in manufacturing. If you look at the housing market, in terms of if you're in the business of selling an existing home, well, you're in a recession too. And if you're selling stuff that goes into renovating a house upon a sale, like paint or carpet or flooring, well, you have a challenging business as well right now, including furniture. But if you're a big builder that's building out a fresh community because the market needs more supply, then your business is doing better. You look, take the consumer. If you just listen to what Pepsi said in their earnings call, if you're a lower income consumer, living in challenged times because of the cumulative rise in inflation, and now you're worried about your job with the pace of hiring slowing down. And I'll get to the labor market in a second. But if you're an upper income consumer, you've been able to absorb the higher cost of living much better than somebody else, and you're still spending on vacations and going out for dinner and so forth.
Right.
That's a strong area of the economy. If it would take capital spending and tech, if you're anything touching AI, business is great. If your business is touching smartphones or PCs, your business is not so great. If you're in business where a lot of your revenue is derived from the government, like in healthcare via Medicare or Medicaid, well, things are great. There's 10,000 people turning 65 every day. If you are a construction worker that's building a fab in Arizona, or building an EV factory in Kansas, well, it'll take you 2 years plus to build that, and you got a job for the next couple of years. But if you're a construction worker who used to build office buildings, well, things are much tougher. So there are a lot of pushes and pulls here with the economy. And I'm still amazed at how many people just painted, as I said, with a broad brush. Now, with respect to the labor market,
Yes.
the Friday payroll number was great on the surface, and hopefully maybe that's sustainable. But you look at the average work week, and it fell, not including COVID, to a 14-year low. And if you look at the third quarter generally, aggregate hours worked is basically flat. Growth is being generated by faster productivity growth, which is a good thing. But you read the beige book from early September, and every district, it was at worst, or I should say at best, very modest growth in terms of hiring. And at worst, there was no growth or even a slight reduction. So that did not square at all with what the Friday payroll number said. I hope the Friday payroll number is more right, and I think that's also confused the Fed. The Fed creates the
Right.
beige book, all their districts, and the Fed voting members read the beige book and said, hey, our own districts are telling us that the labor market is moderated. That's why we need to cut 50 basis points. So that's even adds to the confusion about
Yeah,
what these sort of mixed signals are presenting to us.
exactly, exactly. Because that was Powell's main point, right? Is that's why they had to do the cut because of the softening labor market. Now these numbers come out, which begs the question, and even Ray Dalio voiced his opinion on this, that the Fed will not be as aggressive come the next FOMC. Do you think this changes the path here for the Fed?
Well, I think in the short term, because I do think you could get a reversion back to that slowdown in hiring. But we've also seen a few different things since then. We've seen oil prices lift because of worries about the Middle East. We saw China come out with their initiatives to try to put a floor under both their stock market and the residential real estate market there. If there's any success in some of these things, you could see a bottoming in goods prices because that's where most of the disinflation has taken place. Now, on the flip side, I do expect further deceleration in services prices, particularly on the rental side, which is the biggest component. But when you get into the latter part of 2025 into 2026, rents are going straight back up again. I think the bottom line on all these different moving pieces on the inflation story, which will obviously dictate what the Fed does, is I'm expecting not this natural glide path to 2% inflation and we just magically stay there. I think we're in a world of inflation volatility. And while inflation, like I said, is going to decelerate through the rest of this year into next year, I expect an inflection up again next year as and this inflation volatility is going to catch other central banks. Um, I think you know by surprise. We even you take the ECB, which is likely going to cut again in October. The way that I've described it is just as there's a saying in the stock market, you don't want to catch a falling knife. It
Right.
seems that these central bankers are trying to catch the falling inflation knife, and that yes, inflation has decelerated, and we should all be happy about that. But the key to success in maintaining low inflation is the sustainability of low inflation. The battle has been won against inflation, but the war is not won until inflation stays down. But that takes time to realize. So
Yeah.
all these central banks are trying to sort of, in a way, stimulate things again, just as inflation is falling. But they somehow forecast that inflation is going to stay at this magic 2%. I don't think that's going to be the case. So
Yeah.
while I give some of the central banks I give them, yes, if they can cut interest rates, take some of the edge off the aggressive path upward in rates. But be very careful, though, in terms of the cadence at which you do it, because if you shift too much to the economy and forget about you need low inflation in order to have a good economy, then they may sort of lose this battle, just as central banks did and the Fed did in the 1970s.
Exactly. Really good points, Peter. And just when you were saying that you're afraid that it's painting this rosy picture of the economy, I do think there's a danger there, especially ahead of the election, um, that the jobs report painted this, like you said, this picture of the economy. But at the end of the day, it really comes down to how much can your dollar buy today, right? The purchasing power that we have, Peter.
Right, and we know just if you use the CPI as your measuring stick, even though we can all quibble with that, well, we know it buys about 20% plus less today than it did just a few years ago. But that's been a perpetual story since the Fed was created in 1913. And this iteration is it's not a question of whether we're going to have inflation or not. The only debate is the degree at which you have inflation. Is what is that rate of change going to be? That's really the debate because there's always debasement as long as we have a central bank and as long as we have excessive government spending.
Really great thoughts, Peter Boockvar. Thank you so much for joining us today. We'll see you soon.
I hope so. It was great to be here.
And thank you all for watching. We'll have more great content coming your way, so be sure to stay tuned to the Daniela Cambone Show here on ITM Trading. And don't forget to sign up at danielacambone.com to stay on top of it all. Thanks for watching.